Remember the good old days when interest rates were like 2 or 3%? It was like really easy to get people to buy houses. Like literally everyone wanted to buy a house, and now they're not 2 or 3% anymore. And now people don't want to buy a house, or they're a little nervous about it, or the payment, or they don't want to give up the interest rate on the home they already have. What if we could get clients a 2 and 3% interest rate? Well, we can, and it's called an assumable loan. So every single FHA loan and every single VA loan is assumable. The clients have to be current. So like we've come across some clients that need to make up mortgage payments to get their loan current to become assumable. Um, but a good question, if a client finds a house that they like, is asking the listing agent, is this house a VA or an FHA loan? Because maybe they don't even know that their loan is assumable and they haven't been marketing it that way. Uh, what's really tricky about assumable loans is, let's say a house is for sale at 600,000 and somebody has a $300,000 mortgage on that at, 2.375%. Well, your buyer still needs to buy the house for 600,000, and if they don't have the 300,000 for a down payment, that's where issues arise, and that's where some people stop in this process. But we have several investors that we work with that offer a second mortgage. It's called a piggyback loan, and essentially we cover that gap difference. So if the purchase price is 600,000, now the client still has to bring some money to closing. The most typically 10%. So on a $600,000 loan, that's 60K. We do have some options that are a little bit more tricky, but at 5% down, so that would be 30K on a $600,000 loan. And then we would bridge that difference in the payment. Now, those interest rates on those bridge loans are what's called a piggyback loan, not bridge loan, but a piggyback loan. I'm calling it bridge because it's bridging the difference between what the assumable is and what the how much the client needs. Can be pretty expensive. Like lowest right now is like 7.75%. Highest, if their credit isn't great, could go up to 15%. Now we use what's called a blended rate calculator. So let's just say that mortgage on that is 300,000 at 2.375%. But then our loan at the $250,000 that they need would be, let's just say 10%. We would take those two interest rates together and combine those for a blended rate that is still way under current market rate of, averaging around 6.5% right now. So if you have a client looking at a house, the first thing that you should do is ask the listing agent, does your sellers have a VA or an assumable loan, or a FHA loan? And then if they don't have the difference, that's okay. That's where Danielle is going to come in and help. So let's sell more clients' houses with these assumable loan options, to help them bridge that gap with monthly payment.